Okay, we're getting into the accounting equation and we're going to throw in some transactions to give you some examples of how this accounting equation works in recording some transactions. So we'll start filling out some accounts. These are called T accounts. We're going to go into that in more detail next week. But here's some important things from last time. So the debits must always equal the credits. So when you record a transaction, what goes on the left in terms of dollars must always equal what goes on the right. Any transactions that are recorded, well, you've got to find out what two accounts are affected and what is increasing and what's decreasing. And to help you, always have the chart of accounts on hand. So very important, those few things, to have those on hand. So, to help in this process, we've got a few little tips here. Try and make it bigger. So first of all, read the transaction. Second, think about the transaction. Put yourself into the mind of the business and what's happening. Third, you have to think about the accounts involved. Fourth, you have to think about what element are each of those accounts. Fifth, you need to think, well, is the account increasing or is it decreasing? And finally, calculate, is it a debit or is it a credit? So I'm going to go through some examples and show you how that works. Here are the transactions that we're going to be using. I'll come back to this in just a moment. Remember always to have this debit credit table on hand, because once you've identified the element at the top and you've identified that it's an increase or decrease, then you can match up, hey, it's a debit needed or a credit needed. Okay, so we start with, the starting part is exactly what we had before, where we have some money in the bank. So we'll put this to one side. We've got some money in the bank. That's $100,000. We've got a loan of $30,000. And capital is $70,000. So maybe that's the start of the month that they start out with. So we have these details here. Money in the bank, $100,000. That's on the left because it's an asset. A loan, $30,000. That's on the right because it's a liability. And capital, again, that's on the right because it's $70,000 from the owner. So those are our starting points. So let's go back. We want to record some transactions. And now we need to start to think about, well, these things, there's always going to be one debit and one credit, and at least two accounts involved. The first transaction is there's a cash sale. Cash sale means a customer has come in, they've bought something, and they've paid us into the bank account straight away, and we've made money. So it's $2,000. First of all, we need to think about, well, what two accounts are involved. Now, one of them will be a bank account. We have received cash from the customer. So, received cash, great. We need to record it in our bank account. Bank account is an asset classification element. And we need to think about, well, what's happening with the bank account balance? So, to help you think about this, think about, well, what was the balance before this happened? And now what's the balance after? That can help you figure out if it's going up or down. Here, the balance before, $100,000. The customer puts money in, so we now have more money. We're going to have $102,000 in here in a minute. So, to achieve that, we need to look at the debit credit table. So, we look at increases, decreases, asset going up. We need a debit. So, we put $2,000 on the left-hand side. Now that's only one half of the transaction. Remember, debits must always equal credits. So we're missing something. We need to record the other side of the transaction. Well, this is where we create more T accounts. And in this case, we think, well, where did the money come from? Well, we made a sale to a customer. Simple. Let's make a new T account called sales. Sales is revenue. Revenue here, sales. So we think about, well, sales going up, revenue going up, because we've earned more money from the customer. Well, that's going to be on the credit side. So $2,000 on the credit side. So we have now left-hand side, $2,000. Right-hand side, $2,000. We've now recorded one transaction. Debits equal credits. So we've recorded the first one, cash sale. Now the next one, purchased a vehicle with cash, using cash from the bank account. So we need to think about what two accounts are involved. But again, the bank account is involved. We have paid money out of the bank. So we've purchased a vehicle. What's happening to the bank balance? Bank balance has gone down. So bank balance going down, we go 10,000 credit. You might go, whoa, credit, why credit? Well, go back to the debit credit table. An asset that goes down, to decrease it, you need a credit side. So if you have a look at that T account, we now have 10,000 on the credit side. So what's going to happen is, instead of having $102,000 recorded, we now have $92,000 recorded. Okay, so the other side is we purchased a vehicle with cash, $10,000. So to record this, well, we need another T account. We've now got a vehicle. Hooray, we can drive around. So we now have a vehicle. New T account, and we think, okay, what was the balance before? What was the balance after? Well, we didn't have a vehicle before, the balance was 0. Now we have a vehicle. So asset has gone up. So now that is asset going up. It's $10,000. Notice that these two are both assets. One asset has gone down, one asset has gone up. One's got a credit, one's got a debit. But it's all in balance. And if you added all these up, yep, we're still $102,000 on either side. Okay, next one, we have purchased inventory, but we've purchased it on credit. So what this means, the word on credit, means we have not yet paid for it. So it's probably going to be a liability account because we haven't paid for it yet. So we have purchased inventory. We need a new T account, one a bit smaller. And it's going to be called purchases. Now, if you look at your chart of accounts, you'll see what element that belongs to. But purchases is an expense. It's a cost of running the business. So we've got some costs to the business. Again, think expenses. Okay, my expenses or the costs of the business have actually gone up. So we need to actually put this on the debit side. The costs, remember, just remember that the costs are going up. Don't think about the profit element just yet. That's for a later stage, we do that. Now we think about the other side. Well, we've done purchases. We've purchased the inventory. Now we need to record that we actually owe someone some money on credit. So this is going to be a liability that we record. The name of that liability is creditors. So creditor is a supplier that has sold us something that we owe them money. So creditor is a liability. What's happening to the balance? Well, yesterday we owed $0. Now we owe $1,500. balance has gone up. The balance is going up. Look at the debit credit table. And 1,500 credit. I can show you. So a liability now increasing needs to be on the credit side. But you'll see that the debits and credits still equal overall. So as you record each transaction, if your debits equal credits, yep, no problem. Okay, so we've recorded 3 transactions. Last one that we're going to record here is purchase a new computer. Now, you'll remember me saying before that there's at least 2 accounts involved. Well, this is a special one that involves 3 accounts. Okay, let's read it. Purchased a new computer for the office. $2,000 is the total of it. We paid a $500 cash deposit paid, and the remainder we will pay in 30 days. So there are 3 accounts involved here. 3 accounts. First of all, well, we have a computer. Just like a vehicle, we now get to record that we own something. So, computer. Now, computer is something that is going to be there for a long time, going to give us future benefit, so it's going to be an asset. Now, what's happening to the balance? Well, yesterday we had no computer, now we do have a computer, so the balance has gone up. How much is the value? Oh, we go and have a look. Purchase a new computer, the total of it was $2,000. So, that is the amount to be recorded on the debit side. $2,000 computer. Now, we need to record the rest of the transaction though. We've got this amount on the debit side. What's the credit? Well, we're told that we paid $500 cash. So, what's happening to our bank account? We pay some cash out of the bank account. That makes our bank balance go down. So, $500 goes out of the bank. Again, still doesn't balance though, does it? What's the amount owing? Well, $1,500. So, this is going to be another creditor, another amount that the business owes to a supplier. So we're going to add another $1,500. So now this account, we owe various suppliers $3,000. We did some purchases, we owe some money on a computer, now it's $3,000. So this is recording those transactions. So we've just recorded those for the starting and the 4 transactions. You know, cash sale, purchase of a vehicle with cash, inventory, and then a new computer. Now this is recording it in what's called T accounts. Now this is sometimes a bit hard for people to get started, but this is what's happening to each individual account. What we're going to show you next is how I'd like you to start when analysing a transaction. And that's actually using some different columns. So instead of using T accounts, we can now actually just use various columns to record those details. So the columns to use are these. So we have the date, the account affected, the element, is it going up or down, is it a debit or credit, and then finally the amount. So we can actually work through those same details that we've done here, but actually record them in a column format. And this is actually quite an easy way to start figuring out, well, what's a debit, what's a credit. We'll come back to the T accounts next week. So let's have a look at some of our transactions. Same 4 transactions. A business makes a cash sale of $2,000. So we start off with the date. I'm just going to put the first. Now, 2 accounts are affected. So they're going to be 2 rows are going to be affected. And you can sneak back and have a look at here if you want to, but you should be able to remember, what are the 2 accounts involved? Well, our bank account was involved because money went into the bank. The second one is sales was involved. Right, let's work through each of these accounts. Bank account, what element is it? It's an asset. Okay, our bank account, is the balance going up or down? Well, money's coming in, balance is going up. Now that you have these 2, asset and going up, you can use the debit credit table to identify whether you need a debit or a credit. In this case, a debit. And then finally the amount, $2,000. Okay, let's just work through one side of the transaction. The next one, we have sales. What element does it belong to? Well, sales is money from customers that we earn. So that's revenue. Has the amount of money from our customers increased? Well, yep, we've earned more money. So that's also going up. Revenue going up. That's a credit. So that should be on the credit side. $2,000. Now, if you look back to the T accounts, you'll see that the same thing has been recorded here. So the $2,000 of sales, that went into the bank account, and that went on the debit side. Good. Sales, that's the revenue, that increased, so that's recorded on the credit side. So, same transaction, same way of doing it, but just a different layout to help you get to the debits and credits. Okay, so that was the first transaction. Second transaction is we are buying a motor vehicle. Okay, I'll run through these quickly. So, motor vehicle for cash, that's our bank account. Again, you can pause this at any time, work it through yourself if you want. Bank account is affected, it's an asset, the balance is going down, so that's a credit, and it's going down by $10,000. Our vehicle account has gone up, it's an asset, so that makes a debit, $10,000. So bank and vehicle are the 2 accounts involved. Okay, third one, we purchase supplies or inventory from a creditor for $1,500. So again, put the date, just making it up this one. So we have purchases. Our purchases was an expense account. Our expenses or costs of running the business have gone up. So that needs a debit, 1,500. The second line on the 3rd of January. Our creditors. Now that's a liability. We owe money. Has the balance of our liability gone up? Oh, yes it has. We now owe more money. So, that's a credit, 1,500. Remember to keep looking at the debit credit table to figure out whether debits and credits. Highly recommend that you write it down, put it on the wall. You will need it for the first test. Okay. The last one is purchase of a computer. Computer's purchased for $2,000, $500 cash deposit paid, remainder is owing. So, we have 3 lines. We have the computer, that's an asset, the balance of the asset is going up, so it's a debit, $2,000. Our bank account, that's also an asset. Now this is the amount that we paid out to as a deposit, so our bank balance has actually gone down. That's a credit, $500. And finally, we have creditors. That's a liability. That's the amount that we owe to the supplier. The amount that we owe, well, that's gone up again as well. Use the debit credit table. That's also a credit, 1,500. You'll notice that if you total the credits, the two credits, that equals the debits. So as you record each transaction, you need to make sure that the total debits equals the total credits. Okay. Oh, which is what I've done. Golden rule, debits equals credits. So, check debits equal credits, very important. If you find you've got two debits, or you've got two credits, just go back and think, okay, might have to check, is it increasing, decreasing the right way? Just go back and hunt to see what you've done wrong. Now, we'll use all of these later. So, all of these columns, all the practice exercises that we're going to be doing, we're going to be using them and recording them to T accounts later as well. Okay, so that's been it. That's been some examples. That's been using the debit credit table, using and recording some transactions.